If you're not invested, you're losing money every day, right? Everybody knows where inflation's been. It may have subsided, but it still exists, and it always exists. So inflation eats away at your money every day. So you got to invest in something. And then the question becomes what?
Welcome to the Path to Passive podcast, where we talk about building wealth and empowering lifestyle through commercial real estate investing for tech professionals. I always wish that other tech professionals reaching financial freedom had documented their journey along the way, so I'm doing it for the rest of us. Join us as we explore stories, many failures, and lessons learned along the way. I hope you enjoy and subscribe. Michael, thank you so much for being here. Certainly appreciate you being on the show. I've been checking out some of your other content as well. Huge expertise. And I love that you're here to talk to other tech professionals. There's some questions and content we're going to get into that I think can really help others to, see things from a different perspective, and just having the voice from someone that's been in tech and, a well-known firm as well. And some of your experience can really help to see, have people hear about, someone that's very similar to their journey as well. So, without further ado, can you tell us a little bit about your background and where you're at right now?
Yeah, thanks. Glad to be here, Stephen. It's really appreciate it. So quick background, from the tech perspective, W-2 perspective, I spent 18 years at Accenture doing all kinds of technology, as you can imagine, Accenture being one of the leading, consultancies for tech and business around the world. But when I left Accenture, I got into the big business of real estate. I started working for some real estate investment trusts that were publicly traded with 30 billion in assets under management, 10 ticker symbols. And that's where, the passion of tech and real estate came together. And I said, I really got to take the rest of my career through in the real estate area. And that's when I started my company. Aspire Investment Properties and the Navigator Wealth Fund, which is the fund that I invest through with my partner Jeremy Lemire, who's also an engineer. So that's how I got started. That's how I got to here, and we're continuing to find great deals and bring investors into great deals, as well as provide some informal mentorship. We don't have any formal mentorship, but I love helping people in their real estate journey. I think it's a team effort.
Yeah, outstanding. And I mean, certainly some great experience. I've worked with Accenture as well as a customer of mine, but nonetheless, fantastic background. One of the things that struck me right away was the mission that you have. Mission is to help people find their path to wealth, and so I'm really interested to hear right from you. Like, what does that mean? Right? You talked about mentorship, but here we're talking about real estate. We're talking about investing, right? Investing our financial capital as well. So, walk me through, what does that mean to you about mission to help people find their wealth?
Yeah, I mean, I can talk about it in general and then specifically how I do it and how I help people. So, it's amazing to me that even today, you go through college, maybe you're a tech guy, maybe you're an engineer, maybe you're a computer science person, maybe you go get an MBA, and nothing in that process has taught you how to manage your own money and get yourself to a very successful financial position where you're able to control your own destiny, right? It's always about doing the steps, learning the courses in school, and then learning on the job and learning the tech and doing a good job and getting promoted and getting a salary.
Yep.
There's nothing wrong with that, right? That is great. But taking control of your financial future, however you decide to invest that, monitoring how you're saving, where you're investing, that is the unlock to whatever life you eventually want. And so finding your path to wealth, and not everybody's path is the same, is, I think, a core mission that I try to impart to my children and to other young people, because if you start late, you put yourself behind the curve, and you don't want to be there. So that's why I think it's really important to find your path to wealth, however that is for you. And then specifically as it relates to what I'm doing is I have a passion for real estate and kind of all kinds of real estate. There's a lot of different ways to be in real estate. It's not just one thing, as I know your listeners know. And when I started the Navigator Wealth Fund, we did it in a way that is customizable, where we can have different deals and different types of deals all within one fund, and allow people to choose the deals within that fund that they want. So a little bit different than a typical fund where it's a big pool of investments and you as the investor get the average of all
Hmm.
of them. In this case, you get to direct your funds within the fund to specific deals that you want. So that allows our investors to really customize their investments with us to the specific types of deals that fit their risk return profile that they're looking for.
Yeah, awesome. That's going to be a super key part as well. The choosing which assets. I want to talk more about that from the portfolio perspective too. But what you were just talking about is a principle of ownership and owning your own life too, right? Of you go through this whole traditional model of school, work, promotion, et cetera, but taking ownership to your own finances, et cetera. So you mentioned that different types of assets. Yes, it's something I've definitely talked about a little bit. We're focused a lot more on commercial, which is great. I've heard a little bit about your backstory that you went to open up, and under your quest to investing and looking for passive income, you went through salons. You were looking at single family and vacation rentals. It's cool because you get firsthand experience around the comparison of these different assets. Right. So I'm sort of curious, what was it? What was it for you when you were first starting out investing? Like, what was the vision for you to invest? Why did you first start invest?
Yeah, for me, it's funny when I think back to when I was high school, college. I used to say I want to be an entrepreneur, and
Mm.
then people would ask me like, "Well, what do you want to actually do?" Right?
Sure.
That's interesting to say, right? But what are you going to do with that? And I've always been a kind of learn by doing. I dive full in and I figure stuff out. So certainly I do my prep and read ahead and get smart and all of that. But
Hmm.
but for me, I get into things and do them, and that's how I learn the fastest. And
Right.
so, at some point, I became less interested in just climbing the corporate ladder, so to speak,
Hmm.
and more interested in controlling my destiny in terms of both unlocking unlimited potential in terms of compensation, because it's whatever you make of it when you're on your own.
Hmm.
Also freedom of time, freedom of location. Those two things
Yeah.
to me is how I want to spend the rest of my life. And so I set out on a journey to do that. I tried a lot of different things, as you mentioned. The hair salons were one of my first big ventures into, hey, I'm going to run my own business.
Right.
And we probably don't need to spend a whole lot of time on it, but just real quick, I can tell you, um, the hair salons were pitched, and it was Great Clips hair salons. They're pretty popular around the country. They were
Hmm.
new to this market that I'm in, which is Boston,
Hmm.
Massachusetts. And it's a passive income job. You hire a manager, you get the lease, you organize the build out, you run the marketing. I'm like, it's all turnkey. I said, this is great. Like,
Right.
I don't know, I know a lot about business, but I'm not an expert in every piece of this stuff, right? So
Mhm.
I'm going to buy a franchise. They're going
Yeah.
to lay it all out for me. I'm smart. I'll figure it out and do it. And then I can step back once it's set up. Well, hair salons are a challenging business. They may
Mm.
not be complicated, but they are challenging, right? It's challenge. Staffing is challenging. Working with customers is challenging, and it became significantly more work than I was expecting it to be. And
Sure.
working full time, that and then and the scale. I ended up opening two, and it was just tough to find good real estate leases that worked in that model.
Mhm.
Everybody had that challenge in the Boston area, and I said, you know what? By the time this scales to the point where I can actually bring a GM in to do this work,
Yep.
it's the time I don't want to put in. So I backed off that, and I also at that point got into the real estate, the REITs, and I said, this is the path for me.
Yeah, awesome. Yeah, it's funny, right? It's the business plan works on paper. It looks real good, right? But execution implementation is always a little bit different. And like you said, simple, not easy, right? And that's
Yes.
simple, not easy. But I like the salon. It's a fun story, but I'm sure it was a learning experience and chapter altogether. But you know walking through some of those different things, I know on the topics as well that I think is important to really reinforce more and more, because there's so much information, right? Especially in tech, it's we're constantly inundated with, new things, whatever it is, AI being the hot topic. But why do something like, what about single family homes or vacation rentals, or a secondary home, like those things are you tried as well. Are those things that you're still into, or where have you pivoted to from instead?
Yeah. So again, right. So the way I learn is to jump in and do it. So I had this idea that I think many people have when they're younger, and they say, "Hey, why don't I buy a vacation home somewhere where I like to go?" For me, that was skiing up in New England. I bought a ski condo up there, and then I'll just rent it out, and it will pay for itself, and it'll pay the mortgage, and
Right.
I get to use it whenever I want. It sounds awesome. And so I did that. I went out, I bought a ski house, I set it up to rent. I started using it some. I found I really like to use it to go skiing.
Yep.
Um, I ended up using it at all the times when other people wanted to rent it.
Oh yeah.
And sure, I did it for about 8 years. I rented it. It was a pain in the butt, to be honest, right? I mean, it's like every time you leave, it's like leaving a rental property. You can't leave your stuff
Gotta
all
be
around.
nice.
You got to lock it up, and then when you come back, it doesn't look like the way it did when you left it, because
Right.
even if you have somebody come in and clean it and all that, stuff's moved around, stuff's broken, stuff's missing. I had a really nice picture of the area from about 80 years ago. I love. It went missing.
Oh no.
Weird story. It showed up like 6 years later at my doorstep. I have no idea. If anyone listens to this and they're the ones who took it, just please tell me the story. I got to know where it went. And ultimately, it didn't pay for all the expenses. It defrayed some of the costs, but I loved it. I used it. My kids grew up skiing. We had a great time. So if you want a vacation home and you want to spend the money on it to use it, that's great. As an investment, there's way better places to put your money. I could have taken that money, put it in the S&P 500, made way more money, and that's really simple. And if I put it in real estate that actually made money, as opposed to real estate that cost money, I would have done much better too. And I could have taken that and gone on all kinds of vacations. As it was, when you're invested in a place, you go there all the time. You got your equipment, you got your season passes,
Sure.
you got so going somewhere else seems like, well, a waste of money. So you really kind of get locked into where you bought. At least that's what I found.
Yeah, well, be on the lookout for the story of your photo. Sorry about that.
I'm glad I got it back.
Yeah. I mean, those listing if they know anything about single family, homes, and there's probably some of them that are listening here, they're thinking, sure, it's income, but what about the equity that might be in the house and things like that, right? I don't want to get too far into that, but it's something that to really be aware of as well, right? Like the cash flow is what we're talking about, and making money from it. Well, what would you say about that equity part of for those 8 years?
Yeah, I mean, so the equity went up, right? I definitely sold the property significantly more than I bought it. But when I think about it as an investment and my rate of return, equity plus cash flow, and you put it together, it still was not a great investment. I made much better investments in all kinds of other places. And, it costs money to hold real estate that way if you don't have cash flowing real estate. So
Awesome.
that equity sounds great, and it is great, especially if it's a house you're going to live in. You got to live somewhere, and you get some equity out of it.
Mm-hmm.
That's great. But for me, I think multifamily is significantly better in terms of just an investment vehicle. And one of the reasons is the way multifamily gets valued, which is different than how single family gets valued. I don't know if you want me to go into that in some detail.
Please talk to me about that. And I think that's a perfect segue, because, just putting a bow on that too, is that you can't eat net worth. And, it's useful to have, the cash flow through that entire time of holding too, right, is something that you're going to need. So yeah, go into that. Please talk to me about multifamily.
Yeah, so I think most people know single family houses. If you're going to go buy one, or you're selling it and you try to figure out what is it worth, it's largely based on comparable sales. So what does another house that looks just like yours in your neighborhood sell for? And of course, if there isn't one, they try to find ones close and make adjustments. And that's how you figure out how much your house is worth to sell or how much you should pay for a house. Now, multifamily, and when I say multifamily, it's 5 units or more. So anything 4 units or under, comparable sales is still the key valuation metric or valuation approach. On 5 units or more, the main valuation approach is how much money does it make? So it's more like buying a business than it is buying just a piece of real estate. It's a real estate that is a business. That business is supposed to make money. And the amount of money it makes drives how much somebody's willing to pay for it. So if your business, if your building made $100,000 a year, somebody may be willing to pay 10 times that amount because they figure they'll get it back over 10 years and then they'll own it for free from there, right? So, that metric is called a cap rate. And we probably don't need to get into the details there, but a cap rate essentially is the market rate by which how much money the building makes determines its value. And at the end of the day, what you really got to know is the more money it makes, the bigger the value. The less money it makes, the less the value. And so that means you can get into a multifamily property, and if it's making a certain amount and you can make it make more money, you can force value higher. It's called forced appreciation, which is very different than market appreciation, which is what you get in the comparable sales. So you have much more control to make your business, make your property more valuable more quickly. And how do you make it make more money? You do things like potentially make the outside look better, make the inside look better, renovate it, and ultimately drive higher rents. Get people to stay longer so you have less vacancy. There's lots of different mechanisms by which you make your building make more money. And when you do that, not only are you making more money every month, but you've increased the value significantly.
Yeah, awesome. I mean, it's that business plan, right? There's a significant difference from buying a single family home or that vacation rental and investing in a business. Real estate, that is a business, and the ways to, do that value add, like you're talking about, and cutting expenses so that you have that higher operating income altogether. Appreciate that. So, I mean, if I'm a tech professional and I'm just getting started, as an example, I'm someone that probably has my money in the stock market, right? We have stocks that vest on regular schedule, as we do, FANG or MANG companies as they are. Talk to me briefly around, like the comparison. We're talking right now some differences amongst the single family and multifamily, right? But is there any comparisons of why I should actually take money out of stock market and go into investing?
Go into investing in real estate. Yep. So I think, this is about finding your path to wealth. And for me, and I think what most money managers would say is that it's good to have a diversified portfolio. Certainly there's some people that just invest in what they know. And if it's real estate, it's all real estate. If it's, I really know tech companies and I research the heck out of them and I pick out the winners and I'm good at it, then that's what you do. But for most of us, investing is something that's not a full-time thing that they do. It is something that we do to, build our future, find our path to wealth. Yep. And to do that, I think it's important for me, and what a lot of people think, is to diversify. And diversification, stocks, bonds, small cap, large cap, international, US, that's your traditional Wall Street diversification. But then there's the whole area of alts or alternate investments. And most of your Wall Street brokerages won't tell you much about them because they don't generally offer them. They don't make money on them. So when you unlock the world of alternates, which is oftentimes takes, it doesn't fully always, but sometimes it helps to be an accredited investor, which means you have a fairly significant amount of money to invest, like a net worth of $1 million is a common threshold that makes people accredited. You unlock this world of alts that is just a way to further diversify. And if you look at the stock market in general over a longer period of time, the returns there tend to be lower than what you would get if you are smart about picking your alts. Alts can, whether they're oil and gas, real estate, hedge funds, things like that.
Mm-hmm.
You can, sometimes double on average the returns you'll get out of the stock market. Takes a little more work. Got to look into it. Got to understand it. You got to pick your right investments. But when it's real estate, and if you have an interest in real estate, it's something to get your head around pretty quickly to understand, and really can improve your overall returns. I would just add, the other thing is when you're younger, it's about building wealth. Like, how do I get more net worth? That's really important. As you get older and you start thinking about how do I live through retirement and how do I generate cash so that I don't have to work or I don't have to work as much, then a couple of things come into play. One is the cash flow is pretty important. And you can pull money out of the stock market, but I think everybody knows the stock market goes up and down.
Sure.
You need to pull it out when it's down. You significantly change your returns. Your average returns drop significantly if you're not pulling it out on the upper ends of the peaks and valleys. If you're pulling it out on the lower ends, you significantly reduce your returns. So what I love about real estate is it gives me the ability to not only get some cash flow along the way, so I don't have to pull money out of investments as much, but also as you build equity in the real estate, you can borrow against it. So the stock market's down. This isn't the year to take money out of the stock market. If the stock market's down, it happens to be up right now. But in years when it's down, I don't take it out of the stock market. You take it out of your real estate equity, whether that's through a HELOC or refi, whatever. You have equity there that you can pull some that bridges until the market is high again. Like now. Now's a good time to pull money out of the market and put it back into something like real estate that can grow and you can draw from when the market's down.
Yeah, awesome. I mean, there's a lot of nuggets in there. I think, especially one of the ones that, I'm keenly aware of is timing the market, right? They talk about time in game as an example, but not to get in that too much. I was thinking about it from the perspective of, in tech, we get a lot of, cash or, stock vesting, especially, mid-year and then end of year is usually when the cycles are for many of the companies, depending on who you're at. Some might be monthly vesting, et cetera, but getting those stocks and converting them, right? Because you talk about really, you're starting to allude to, how real estate can be a component of a modern portfolio, right? Is there any more that you want to add to how real estate fits into a portfolio?
I guess I think if I build on that a little bit, real estate isn't one thing, right? Real estate, you can go out and buy a single family, you can go buy a 5-unit, you can go buy a 50-unit, you can get in groups of investors in things called syndications or through funds like the Navigator Wealth Fund that I mentioned that I invest through and I run. So there's a lot of ways to get in, and then what you get into within those funds can be vastly different. You can be lending, you can be an equity investor, you can be in commercial office space, which is an area that's ripe for opportunity in the future. You can be in multifamily. So when we say real estate, it's just not one thing. And I think that people who haven't been into it yet just think, oh, real estate is one thing. It's very different. Lots of segments, lots of ways to get in, lots to learn. And regular listeners of your podcast, I know that.
Yeah, I'm glad you mentioned that too, because I haven't really talked much about fund model or even something like a fund to fund model as an example. But talk to me a little bit about the structure of Navigator Wealth Fund. You talk about there's these different assets and it's not blended. What does that even mean? If I'm brand new, walk me through, in as much detail as you'd like to. We can spend some time on this. What is the fund? How is it structured? What does that mean? Like, if it's one entity, how do I invest in multiple? All those kinds of questions.
Yeah, sure. So, let's say the Navigator Wealth Fund, if you were an investor, maybe I'll just take it from an investor standpoint.
Yeah.
So we would have a deal in the Navigator Wealth Fund. Let's say it's a private money loan. So what we'll do is the Navigator Wealth Fund will lend money to a developer to develop a property at a certain interest rate. Let's say it's a 12% loan. And that developer will pay that loan back, pay back with interest. And the Navigator Wealth Fund will make money. So from an investor standpoint, if you like that deal, for us in the Navigator Wealth Fund, it's not all my money. So I have my money in there, but it's also investors that invest into the fund and say, I like that deal. I would like to invest alongside of you and be part of it. So the investor would invest their money into the fund. It's one set of fund paperwork, which it's really lengthy, but generally speaking, you can't change it. So you read it, you understand it. And it's just like any other type of private placement. Once you're in the fund, then you say, okay, I would like my money, my $100,000 or whatever the number is, and I would like to allocate it into that deal. And so within the fund, not all funds are like this, but our fund is set up such that we keep the financials of that deal separate from any future deals. Maybe there's another mobile home park we invest in or self-storage. Whatever happens with those is not going to affect the return of that particular deal. And so you as the investor would get your pro rata share of that loan that we just talked about, because that's what you've allocated your funds into. And then maybe the next deal, you say that one's not right for me. It's not what I'm looking for. Maybe the next one is one that you do like. You can again invest and allocate to that next deal. And then at the end of the year, you just simply get one K1 document for your taxes, and it aggregates your pieces together. So it's pretty simple from a tax planning perspective. You get one set of updates from myself and my partner Jeremy that run the Navigator Wealth Fund. We're always available to talk to investors. We love talking with investors and people who love real estate. So, I think it helps a lot of times when you're getting started to get to know somebody or one group of people, get to understand the types of things they do, how they communicate, how they think about deals, because building those relationships can be challenging. So once you have one that you're comfortable with, it's always nice to just keep building on that.
Yeah, certainly, because they have so much context about the things and your plan, right? Path to wealth, so to speak.
Yes.
And that coaching is invaluable. I mean, it's priceless is another way to say it, because, knowing where to go with the investments. You said something there, and I think I appreciate you laying out, right? It's, there is a set of paperwork, an LPA agreement, a subscription agreement to go into that fund right away. Then having an option to go into these different investments. And you laid out the one about the construction example, but you also mentioned that there is, when new investments come up, to go and pick those. So if I'm a new investor, I'm thinking, all right, so I have this opportunity where I can invest in the fund. I can pick the investments in the fund as well. What do you say to the newer investors, how they would go about picking those investments, like, answering a little bit of that how question? It's like, you talked about, net worth at first as sort of this customer investor journey, so to speak, but also cash flow later. Like, what if I want cash flow now, instead? So, how do you talk about that? How do you advise and, help pick investments where it's really their choice, right? It has to be their choice around making these investments.
That's right. Yeah. Oh, it's absolutely their choice. And that's the great thing about a customizable fund. It's not blind. I don't pick the investments for the investor. They pick the investments. So I really view myself as an advisor to help them understand what their options are. And there's no one answer. I mean, every individual situation is different. And what I love to do is talk with people about what they're trying to achieve. And people at different phases in their life and different circumstances may have different things they want to achieve. And I'll just give you a couple examples because you mentioned a couple of them. So let's say somebody relatively early on, maybe they're a tech professional, they're doing really well. They've been able to save some money, and now they're ready to start diversifying their investment into these private placements. They don't need the money, maybe in the short term. Maybe this is money that they want to save to build that nest egg to retire early. Maybe it's something that they want to save for, a large house in like 5 or 6, 7 years, whatever. And
or go on vacation at another vacation, yeah.
Or go on vacation. Who knows? Yeah. So, and these, if that's the case, then those people tend to like deals that are equity. When we say equity, meaning that they have a partial ownership in a piece of property. And the reason that those are typically interesting is that there's usually the potential for larger returns. versus and larger risk, right? So the equity, if the equity goes up, that's great. You can do really well, and that forced appreciation we talked about can drive that. And so you can see a business plan on a lot of the equity plays
Mm-hmm.
that create some very, very attractive returns.
Yeah.
I say it's a little higher risk because if you compare that to, let's say, a private money loan like that construction loan I talked about,
Mm-hmm.
that construction loan is in a much more secure position because if something were to go horribly wrong and the whole building was to become a disaster, get wiped out, whatever the case is, and insurance didn't cover it, and some disaster situation, the loan gets paid first.
Mm-hmm.
The equity gets paid last.
Yeah.
So there's a lot less risk in a loan, but you're not going to typically get the same returns that you would in an equity position because you're not taking as much risk. The other nice thing about a private money loan is the scenario of the person you just said that really wants cash flow now.
Yeah.
Loans generate cash flow now. Equity will generate some cash flow now from the rents,
Mm-hmm.
but loans will tend to generate more cash flow now. But equity gets the bigger pop when you sell when the property is sold because the equity went up a lot
On the exit, typically for that business plan.
That's right. So I have a lot of retirees or pre-retirees that like to invest in loans through our fund
Mm-hmm.
because they want the steady income. They want the checks every month, and they want it better than the 5% they get in T-bills or bonds or
Mm-hmm.
money markets or CDs. They want double that, and they want to get it every month, and so they like the loans and they like the risk profile of loans because they're getting close to, like, I can't lose a big chunk of equity. I'm too close to the end of my working career.
Sure.
And the other, I'll just add one other nice thing. I know you've had somebody on who talked a lot about IRAs
Mm-hmm.
and self-directing IRAs. So we love self-directed IRAs or 401ks.
Mm-hmm.
And the challenge with self-directed IRAs is that if you are in an equity position and there's a loan on the property, there's almost always a loan on the property, you end up getting into UBIT tax, which is unrelated business income tax. And I'm not a tax professional, but look, it's not the end of the world. You pay it. It's a bit of a hassle. And there's nothing wrong with it. But with a loan, no UBIT tax because it's a loan. You're doing the loan. You're not leveraged with a loan. So people with self-directed IRAs really like the lending area.
Awesome. Yeah. And I appreciate you giving examples too on both sides, like equity, how that fits, and what that could mean for cash flow. And then on the lending side, what that means as well for the cash flow. I mean, you talked about, typical people in their, we'll call it stages of life, and maybe, stages of what's important to prioritize for them. But I think just generalizing in what's important to them, I mean, there's many tech professionals that could have, that could say, hey, I want to get in on, who might be, 32, 3, 4, 5 years old, who want cash flow now as well. Would that also be a good fit for them if they wanted to just get cash flow through those loans?
Yeah, absolutely. Like I said, no one size fits all, right? It's about what the goals of the individual are. And sure, there's people in their 30s that are saying, hey, the more I can build my steady cash flow, maybe my wife doesn't have to work, or she doesn't have to work as much, or my husband, or maybe I want to be, building cash flow to go do a vacation in Hawaii for 2 weeks every year, or wherever I want, right? So everybody's got their own motivations, got their own reasons. They're either looking for cash flow or they're looking to build equity, or some of both and somewhere in the middle. And just helping them understand what their options are and how to think about the options that are out there and how that fits in. That's what I love to do, and help people find their path to wealth. Right, back to the earlier story.
Yeah, I love that. It all roads lead back to home in that respect. One of the things you talked about is since we're on the topic of not only the private money lending, but also we talked about retirement a couple of times and really owning your own financial future. You talked about this idea of a retirement rule, of a 4% rule. Talk me through what is that? How do you how do you go? We're overachievers here. Everyone that's listening here is overachievers. That's kind of my people. So walk me through, how do we beat the average?
Right. So let's just start with what this 4% rule is. And it was a study done over a long period of time of the stock market. And the question was, how much money do you need to retire? Right. And that was assuming an investment into Wall Street products, stocks and bonds. And the rule that came out of it, the 4% rule, is that you have to save enough money that you can live on 4% of it.
Wow. Okay.
And if you can live on 4% of it, you won't run out of money by the time you're dead. That's what this fairly in-depth study has said. And just to flip that around, in order to, just doing the math, right? 4% means you have to save 25 times as much money as you need to retire on annually. So if you need $100,000 a year, you need to save $2.5 million.
Got it. Yeah.
To be able to pull 100,000 out. And that includes, that accounts for things like there's inflation. There's also taxes. As you pull money out, you get taxed on it. So different things like that are factored in. That's why 4% seems like a really low amount. Like, I can make more than that in the stock market. You got to factor those other things in.
Sure.
And so, a lot of people are like, geez, I need to make 200,000 a year. That's $5 million. That's a big nut, right? So, and if you go talk to a certified financial advisor or your stockbroker, a lot of times that's the rule. They think it's fairly conservative. There's a study behind it, and they'll suggest that that's where you got to get to. Nothing wrong with it. I just think that there's a lot of ways to beat it, right? And it gets down to the types of things that we're talking about in terms of investing in alternates, where you're not just getting the averages out of Wall Street. And you have enough diversification so you can pull money from maybe those alternates from that real estate when the market's down, because that drastically hurts you in your retirement. So all of those things, how to beat it, I think it's about investing in alts. And for me, that's real estate. I don't get into much of the other stuff because real estate's what I know, understand, and love. So, there's no question you can, if you look at private placements, which is what we're talking about, private placements in real estate over, a fairly extended period of time, even from, 2008 till now, significantly higher than returns. We're talking probably 12 to 16% is most of the deals I see.
Yeah.
That's a whole different game from Wall Street's 4, 5, 6.
Yeah, I was just gonna say, it's so interesting. I have a friend of mine who worked for banks and stuff, and I talk about some of these alts and alternate private placements. And it's like, well, you could from an IRR perspective, for 14, 15, 16, 18, he's like what are you talking about? It doesn't make sense. It's like the first time hearing about it, and what are I have questions here that we'll get into in the next section, but just to tie this part off, you talked about the UBIT thing, I'm going to have a future episode as well to dive more into that as well. And you talk about capital stack with the lending as well as equity. I have an episode on that you guys can listen to. More on that. I find that that was done before, but I want to talk to you a little about sort of two parts here. So moving toward the theme of great. So I'm interested in cash flow right now. How do I evaluate a private money lending opportunity? And then the second one is, okay, you've touched on investing, with in IRAs or retirement accounts. How do I do that? And how would I invest in these funds? So that's sort of three, but let's start with how to even evaluate an opportunity before I would invest in it.
Yeah. So when we talk about evaluating a loan or a private money lending opportunity, there's a few key things to look for. And let's assume you're doing it through, a professional organization that does this, as opposed to doing it on your own. You can go out, find somebody, loan them money, that's a whole other game, and
Yeah.
you got to make sure you know what you're doing to do that.
Hmm.
But if you're investing, through a company or a fund or someone who does this, there's a few things to look for. One is the loan to value ratio. So this is, to me, the key metric. It tells you how secure your money is. And so let's talk about what loan to value means. The project, whatever the project is, let's say it's a development project, has a value that it's expected to be at the end of the project.
Hmm.
And if you were to loan, or all the loans together, your loan may be one of multiple, right? If all the loans together equaled the value of the project, that would be like 100% loan to value, because
Yep.
you've got lending on 100%
Hmm.
of what that project is going to be worth. If something goes wrong and the project goes over budget, or the value of the project when it's done is not what it was expected, you're starting to lose your capital if when it's sold, right?
Right.
And so 100% is the extreme. You'll hear people say they'll lend 100%. It sounds a little crazy to me. There's something else going on. Be wary.
Sure.
There's
Ask
something else
questions.
going on, right? So and a lot of loans that you might get from a bank for a single family house, those types of things, they might be like 80% loan to value. And there's a lot of programs out there. But for commercial lending, which is what we do, is it's more like 65, 70% loan to value, maybe 75. And that puts the lending in a fairly secure position, because things would have to go wrong on the property, either the value going down or what have you, by 25 or 30% before your capital is at any risk.
Yeah.
So that, to me, that's the security of your loan, and that's the first thing to look for is what's your loan to value for the loan you're investigating. Now, what's interesting is if you say, "Oh, I only want to do a 50% loan to value loan.
Hmm.
I need it really secure." That's great. You're probably not going to get much of an interest rate on it, because there's not a lot of risk there, and there's a lot of people that would lend to that type of a deal, including most banks. And they'll lend it at low rates, and you may say, "Well, it's not worth me doing that for that rate." And so it goes up fairly quickly between, call it 60% and 80%. If you start lending in that loan to value, it's still a fairly secure position compared to equity, but your rates can jump up to 10, 12, 13, 14%. Um,
Hmm.
and now that's a pretty good return, right? And it's still a relatively low risk position. So, it's evaluating the risk and it's evaluating the return to figure out where you want to be. And then you got to look at the kind of underlying pieces of the deal. So that's just the financial numbers, and that's important. I usually start there. But then you got to say, who's the borrower? What's their track record? How confident are we they can deliver this product and this
Hmm.
project? Do they have any past history that would
Track
tell
record.
me they're untrustworthy?
Yep.
What due diligence has been done to make sure that what I'm being told is correct? I mean, if you go out and lend to somebody and they tell you, "Oh yeah, this is going to take $500,000, going to be worth $1 million when I'm done. You're going to make a bunch. It's great." Well, what due diligence are you doing to validate that? And when you work through a company that does this professionally, you do that. They are doing that due diligence, and you should ask them about it, right? I mean, don't trust them either. Ask them.
Yes. Yes.
Yeah.
Yeah.
So those are some of the key things I look at.
Yeah, I appreciate you mentioning not only just what does that look like on like the LTV, the loan to value, but talking about debt and equity. I mean, it's pretty much from a real estate perspective, bonds and stocks, right? Equity position.
Yeah.
And so, but just within real estate itself, and then you also talked about the perspective of like knowing who you're doing business with, knowing who you're putting, parting your hard-earned money with. And so not only the deal itself, but the market, as well as the operators and the people, right, that you're working
That's
with.
right.
Yeah.
Yeah. All the same things that you would evaluate in an equity position: the market, the submarket, the financing, the operators,
Yep.
the business plan. All of those things come into play in a loan, but maybe to a little bit lesser degree. that you have to go as deep in some of those, particularly if you have somebody else diving in on it for you. They can
Awesome.
explain.
I want to make sure that we have enough time to talk about some of these other things. If there's, we won't get into the how on things today, but the strategy is important to cover, like we just did. But I want to talk about from the perspective of, I'm thinking again, I'm talking to someone who's right around, they've been in tech for a bit and they're ambitious. They're looking at, what they can do to maybe get some cash flow now, to also plan for the future, but enjoy life today as well and plan for it as well. Right. And so, you know, opportunities are great, but there's also the risk of not doing it now. Right. So the question being is, with everything that's always in the news that's going crazy, right? Should people still be investing now? Is it still a good time? Like, is there bad times or good times? This is the question that I'm getting at. Is it still a good time to invest?
Yeah. I think it's always a good time to invest. The question becomes in what?
Yep.
Right. I mean, if you're not invested, you're losing money every day.
Mm-hmm.
Right. Everybody knows where inflation's been. It may have subsided, but it still exists, and it always exists.
Yeah.
So inflation eats away at your money every day. So you got to invest in something, and then the question becomes what. And so again, I think with the diversification of a portfolio, you start shifting where you think the better opportunity is, and it's usually not the thing that's hot and getting all the press and going through the roof. At least for me, I look at where are there opportunities? Where do I believe in the long-term strategy, right? And I'll just say multifamily, for one, is a strategy that I think is here to stay for the long haul in the United States. There is a housing crisis in terms of more people than we have housing for. And there's also, it's becoming unaffordable. I can't imagine a young person coming out of college now. I live in Boston. It's a gateway city. It's one of the more expensive cities in the country. And it's happening everywhere. Prices are becoming unaffordable for people to buy a house right out of college the way, some people were able to do when I did it and I was able to do it.
Yeah.
You get a good job, you can do it. It's really tough. So the rental market is strong. And as long as the rental market is strong, a lot of demand, that is driving multifamily for the long haul to increase rents, make your buildings worth more money. And so I still like the multifamily market, even if it's been a bit overheated in terms of they're costly to get into. Mm-hmm. There's opportunities starting to show that hasn't been there in the last few years with the higher interest rates. So I still think it's a good time to get into multifamily. I think self-storage is similar to multifamily. We do a lot of self-storage as well through our wealth fund. But we like both of those asset classes. Commercial office space is ripe for opportunity to buy in the coming years. There's a lot of debt that's coming due, almost triple the amount of debt typical in a year that's been deferred over the last couple of years.
Yeah.
And as that comes due, buildings are upside down because occupancy is not there and values going down. We're going to see a lot of opportunity to either buy distressed debt or to purchase commercial office buildings. So we're not into it today, but it's a market that we are looking at. So again, I guess it's a long way to answer, like, is now a good time to invest? Always a good time to invest, but where? Where do you see things going, right? And then get yourself into that. And at least for me, it's never all in on one thing. It's more allocation. How much is going to any given thing based on where I think the market is going in that area.
Yeah, awesome. It's such a key thing to really get in your head, right? There's always a market somewhere, right? There's always a market somewhere. And if something's up, something else is down. If something else is down, something's up. And so where can you be? And so, to your point about distressed assets as well, and how, you always have to follow the money. Like, think about these different assets you're talking about, or asset classes, I should say, within real estate. It's, well, where does the money come from? And then you can start answering like, okay, well, how much of a return might I get based on where that is? So even if, so for example, even if I don't know, if I'm a listener and I don't know everything, about the self-storage model, I think, okay, well, how does self-storage make money? Great. It's people put stuff in there and they they rent that space time after time. If people are in office buildings because there's a pandemic, then it's probably not doing the best. If people, you know what I mean? And so it's something just to be, really put the investor hat on in a pragmatic, practical way. And so there's always something to invest in. Is what is it? How can I get smart about that? And even if I don't know all the ins and outs, it's like, great. It's more likely that something around a mobile home park or an RV park as well might, think, okay, that's cash flowing too. So I appreciate that. So in terms of, the cost of inaction, right? You talked about inflation, right? It's not only inflation, but, it's, well, if I don't do something, then it then also means that my money doesn't continue to compound as well over time as well. What other, areas of, things, one or two things just off the top of your head of where do people start seeing trouble if they wait?
Yeah. Well, here's what happens. And maybe sometimes it's by plan, but it's when it's not by plan that it's a challenge. Is money burns a hole in people's pockets sometimes. Like if they don't invest it somewhere, they spend it.
Yeah.
And they spend it on something that is not an investment. And then they look back and they wonder, why haven't I saved any money? I have a really good job.
Sure.
I make a lot of money. And when they start taking inventory of where did it go, unless they were conscious, like, I know I want to go vacationing, whatever, I want to do this, or I want to go buy, something that rewards me.
Yeah.
And they're purposeful about it. That's great. I mean, everybody should do that, be purposeful. It's when you are not purposeful and just find out it disappeared.
Right.
Like it went somewhere. I couldn't tell you where. I guess I had a good time with it. So I think that if you're building a nest egg, you got to get it into something, or you're going to get into something maybe you didn't plan to and you'll regret later.
Yep. Got to take it off the top. Got to save it. Got to invest it. Got to have that ownership of your own finances for sure.
Yeah.
One of the things I'm curious about is, and some of these can be more rapid fire, but I think these are really important questions. Is, again, I'm listening as an investor. I'm thinking, okay, I have all these tech skills and stuff, but how do these translate to investing? Like, this is a whole new world of finance, it's a whole new world of investing. Like, walk me through, like, how difficult have you found it in your time here investing? Is it to understand investing come from the tech space?
Yeah, I think people in the tech space have a leg up on many other professions in that technical people tend to be very analytical. Not that everybody is, but tend to be pretty good with numbers and logic.
Yeah.
And if that's the case, that's really a core skill to help you understand the business models of these types of investments. And that's what you need to understand is, and you said it earlier, Stephen, right? Just how does a self-storage unit make money? And you said it very simplistically. And so just taking your kind of logical skills that you have as a technologist and be able to educate yourself a little bit on how to look at that business model in terms of numbers in a spreadsheet and be able to understand the key metrics, like what are you looking for in those numbers?
Yeah.
And that takes some self-education. Quite frankly, that's what I do a lot, is help people understand what those things are so that they can see them and get comfortable with them. But when you come from a place as a technologist, as an analytical person, somebody who maybe is at least comfortable with numbers, you can very quickly get yourself into being able to evaluate opportunities that you're comfortable with and move forward.
Yeah.
And then I guess I would add, if you're looking to do this beyond just as an investor, but if you're looking to actually be an active, real estate person like I am, then, other things that happen in tech, like project management. I'm a project manager by trade, program manager. That's what I grew up in, organizing large projects, delivering them, lots of teams, lots of costs, lots of deliverables, whether, and much of that was technology deliverables. If you're in that world, you get it. You get
Yep.
it. Like I've got a start and I've got an end, and I know what my end looks like, and I need to get there, whether that's the end of a sprint for 2 weeks or the end of a project in a waterfall scenario for 6 months. Whatever it is, you got a goal, and you got to organize around that and achieve it. And if you're active, those are very good skills to have.
Man, I think you just spoke to the hearts and minds of many of the people listening. That's right on. I want to be respectful of your time, so I want to wrap up on some of these things. Just again, rapid fire. What's one or two things you wish you knew when you first started about investing?
I wish I knew that there was this whole world of alts that I could get into that I never thought existed. So I wish I just knew about it to start with. And then the second thing is I wish I'd actually done it sooner. So I fell into real quick. I fell into a trap. I was like, oh, I'll stay at home after college. I'll save money. I'll buy a multifamily house. I'm traveling all the time for my tech job. No problem. I'll get rent easy. And then my wife and I decided to get engaged. And she said, you're out of town all the time. Do you think I'm talking to a tenant? What's going to happen if they come to me and say, my toilet's not working or whatever? Right. So the entire multifamily dream went out the window. I bought a big house in the suburbs. We moved in. And then I didn't really start my real estate journey till later. So I wish I had actually just started sooner. Got it.
And on that note, so starting sooner means, sometimes there's, there might be things where you might get into analysis paralysis that never happens to us tech people. But what do you tell the person who, is starting to understand, like, great, this is something I want to do, but I still have hesitation? What are things that you tell that person and walk them through to coach them on their path to wealth to taking action? Yeah, I think so I help people understand first, why are they hesitant? What's holding them back? And if they can identify that, you can help them identify the path to get over it. Whether that's, I don't really understand how this works, or I don't really trust this person that I'm talking to, I just met them, or whatever it is, there's always a solution to help them get comfortable or not comfortable, depending on what it is. But first, it's understanding what is the hesitation, what is the fear. And the other thing, just to touch on it briefly, is a lot of times people are like, well, I only have $100,000 in my savings account. I don't know if these, usually they're bigger numbers in these investments. They're 50 or 100K minimums. Yep. I don't know if I want to put it all in. And so one of the things that people don't realize is their IRAs, their 401ks can often be self-directed. And if they have that opportunity, it's funny, people think about that money very differently. It's like, well, I'm not going to touch that for 40 years. I could do that. Yes. That's fine. It's not my day-to-day working capital and so forth. And so sometimes people will, once they figure out the self-directed trick, all of a sudden they're like, oh yeah, I got 300,000 in there and I don't need it for a long time. So yeah, let's do it. Yep. Yeah, I'm glad you touched on that too, the emotional part and the logical part, the understanding, but also the trust and the fear. It's not like, hey, go do this tomorrow. It's, hey, understand it and get through that path to understand why you're doing things, what makes sense for your goals, et cetera, right? So what, last question here is, before we close, is what are some of the things, your vision has expanded from where you started. You talked about, hey, we're looking at just supplementing W-2 income, et cetera. What keeps you going today from a purpose perspective, or, what excites you about continuing to invest on this journey? Because it is a long-term strategic game. Yeah, it is. And so, I started out by saying, I really want freedom of time, freedom of location, own my own destiny, and this is my path to do that. Right? I've developed a lot of expertise and put a lot of hours into doing this effectively for myself, for my friends and family. And now it's about bringing others in and showing them the path that I've taken and how I can help them learn and help them invest and help them grow. And I certainly love seeing people who come back to me and they're excited and they're doing some of their own things too. And not everything's with me, and that's okay. I love seeing that.
But for me, this is my forever job, right? This is
Yep.
people ask me, what are you going to do when you retire? I'm like, this is
This is
it. This
it.
is what I like. I'm not going to sit around and just golf all day and sip margaritas on the beach. Like,
Yeah.
I'll do some of that,
Yeah.
but this is fun for me. I love projects. I've always loved doing projects, getting things done. And so, for these types of things that we invest with our fund, they're projects I'm involved in. And that's what I love doing is the
Yeah.
projects.
Yeah. You've won if you're doing what you already want to do. Right.
Yeah,
Yeah.
exactly.
Yeah. And helping others to get there too. Both the external things that, but also the internal transformation. Right.
Yes. Yep. Love helping people, and especially when they come back and they're like, hey, I did it. And
Yeah.
this is how it worked out. It's like, that's great. That's great. I love it. A lot of times we'll do things together, That's
Even
good too.
better. Even
Yeah.
better. Outstanding. I appreciate all the different topics we covered. We talked to hearts and minds today. I love how you threw in a bit there about the project management part two, and just more specifically, start and end, and getting over, showing many tech professionals that the experience they have already is not only directly translatable and transferable, but they have an upper leg already. And I always tell, people, that my colleagues, that our ability, like the things that we do in tech, right, it can be so much more complicated than these models. It's just, we have to go and
Yes.
look and talk to people that can help to advise and help us understand, etc. So on that note, Michael, appreciate you being here. Talk to us about where the listeners can find you, and maybe even what kind of conversations you want to have.
Yeah, so people can find me best is at our website, Navigator. Well, it's navwf.com, which stands for Navigator Wealth Fund, but navwf.com. You can book a call with me on the website. You also got my contact info on there, which is michael@navwf.com. And I'm glad to connect with people on anything in their journey, right? Whether you're interested in investing with me, interested in learning about different ways to invest, just want to connect in general, I'm glad to do that. I also have a lot of educational materials out there on my website, everything from like how to get started with private money lending to what is self-storage operations and how does that work. So lots of different things out there for you to take a look at. But I'd be glad to talk one-on-one. That's what I love doing, is helping people one-on-one.
Perfect. I'll make sure all that's in the show notes. Appreciate you, Michael. Thanks for being here.
You bet. Thanks a lot, Steven.
Thanks for joining us on another episode of Path to Passive. We love connecting with our listeners and those on the path to architecting their wealth and improving their lives. Feel free to let us know what topics you'd like to see in future episodes. Get in touch with us through email or Instagram. See you next week for a new episode.